Okay. Welcome, everybody. Thank you so much for joining our webinar today. We're so glad you could join us. We're going to get started in just a few minutes. You should have a poll that pops up. This is just kind of for fun to see who's in the room. Feel free to answer or skip it. Completely up to you. All right, 12 p.m. Welcome, everyone. Thank you again so much for joining us. We're just going to give it a couple more minutes while we wait for a few more people to join. Feel free to answer our poll. It looks like we have a lot of people from the Northeast here joining us today. Thank you all so much for joining. We also have a lot of people that have a will. So that's great. Hopefully, you learn more about that today. If not, all right, so we're gonna get started in just a couple minutes. Just real quick, everyone, your cameras will be off for this webinar. And we also have disabled the chat. Please use the question and answer box at the bottom of the screen if you'd like to ask a question. And we would just like to remind everyone that we're going to keep our questions general today and not personal. We're going to have a few minutes, 15 minutes at the end of the session to go through some of your questions and answer them. So we're really looking forward to that. Thank you all again for joining us.
Looks like we might be at capacity, Catherine, if you want to.
Great. Okay. Thank you again, everyone, for joining. Thank you for doing the poll with us. I'm going to give it over to Director of Gift Planning, Carolyn Stiles, who's here with us to introduce our speaker, Brad Bedingfield, today.
Thank you, Catherine. Good afternoon, and thank you for joining us. Here today to discuss estate and charitable planning in 2026, what's new and what's staying the same, is attorney Brad Bedingfield from Hemingway and Barnes. Hemingway and Barnes, for those of you who are unfamiliar, is a Boston-based firm that provides a range of services, including legal and financial advice to individuals, families, businesses, and nonprofit organizations. Brad is the chair of the nonprofit group. He is also a member of the Board of Regents of the American College of Trust and Estate Council, and he is a frequent speaker on the topics related to charitable giving and tax-exempt organizations. Brad has over 20 years of experience in private practice with national firms and previously worked as a tax law specialist at the Exempt Organizations Division of the IRS. The Office of Gift Planning here at Northeastern has had the pleasure of working with Brad on a variety of gifts over the years, and we are delighted that he is here to speak with us today. Please welcome Brad.
Thank you so much, Carolyn, and thank you everybody for inviting me to join you today. Just give me a second. I'm going to share my slides. Last summer, Congress enacted what they call the One Big Beautiful Bill Act. And as a part of that act, they made some changes that affect some of the things that we talk about when we're doing both estate planning and charitable giving. And I'm going to go through that, but I don't want to start with that because there's a tendency of lawyers who do what I do and spend a certain amount of time in the tax code to dive right into the tax stuff and start solving tax problems. But when folks come to us for estate planning advice, that's not where their head is at initially. Where their head is at is what's going to happen to me when I pass away? Is my wife going to be okay? Or my kids going to be okay? Who's going to handle the family business? What's my, from a philanthropic perspective, what's my impact going to be when I'm gone? These sorts of practical blocking and tackling questions need to take primacy when you're doing estate planning and charitable giving. The taxes are important, and we're going to get to that. But it's important not to lose sight of what are the real goals of people who are entering these kinds of planning, protecting family, philanthropic impact. So let's start with a little bit of blocking and tackling. It was great to see in the poll that many of you have a will, and that's fantastic. One of the biggest mistakes some people make in their estate planning is not recognizing that the will doesn't cover as much as some people think it does. So this slide talks about the different kinds of assets that people have in different places. Personal bank accounts, life insurance, retirement accounts, real estate, closely held businesses, whatever it is. What happens when you die can depend on what types of assets you have and how they're held. And your will may or may not have any impact on that. Your will applies to assets that you hold in your personal name. Most bank accounts, the family business stock, whatever it is, generally real estate. But many of these categories of assets pass completely outside of your will, and what your will says has no effect on them. Life insurance and retirement accounts being classic examples, unless you name your estate as a beneficiary, they pass according to the beneficiary designations. Real estate we often own jointly with people, and there it passes directly to the joint owner rather than through your will. So you can go through the exercise of setting up a will that says exactly who I want to benefit, how I want to benefit them, how I want them to receive the assets outright in trust, whatever it is, only to find that most of your assets are in what we call non-probate assets, meaning they pass in some other way than by your will. So it's really important to marshal all of that at the beginning of the conversation that you're having with your estate planner and talk about all the different ways in which your assets are going to pass on death to make sure that they all align, that they all work the same way and in tandem. And once you've done that, once you've decided, here's who I want to benefit, here's who I want to get different kinds of assets, here's the impact I want to have, then we can bring the taxes to bear. Then we can say, all right, we understand what your objectives are. Now let's talk about tax efficient ways to get from here to there. One of the first places where we tend to cross paths between that practical blocking and tackling and the tax side of things is with retirement assets. And we work with a lot of people who may not have a whole lot of assets in their personal name, but have significant retirement accounts. And that's a big part of what they're leaving either to family or to charity. And with retirement assets, for the most part, with the exception of Roth IRAs, most of the retirement assets you're talking about have a big income tax component to it, by which I mean that whenever the assets come out of these retirement plans, they're going to get hit with ordinary tax. They're going to get reduced by 35, 37% of their value. And so a big part of the planning with retirement assets is not just making sure that it's going to whom you want it to go, but making sure that you do it in as tax efficient way as possible. And that usually involves trying to stretch it out as long as you can so that you don't have to take it out of the retirement plan. It can stay there investing in a tax deferred way. You can do that easily with spouses. For the most part, you can roll them over to the spouse's IRA and it can continue as it was, not coming out, not subject to income tax. It used to be that you could do that with your kids when you're leaving your retirement account. You could say, I'm leaving it to you, but you have to take out certain amounts every year over your lifespan. A number of years ago, Congress changed that under the Secure Act. And now that those payments have to come out within 10 years, but there's still opportunities to kind of stretch it over that period of time. Deferred taxation is still a benefit for the most part. And when you're given to charity, we're going to talk about this later. These are great assets to use because these are tax-heavy assets, ones that you're otherwise going to get hit with tax. And so the more you can focus those on the charitable side of whatever it is you're looking to do, the better. Now let's talk about some of the other tax aspects of what's happened in the law recently. And when we talk about taxes from an estate planning perspective, we're generally talking about two types of taxes. One of those is income taxes. We've just talked about that with retirement assets. There are some assets that have income tax components and impacts on your heirs, the people receiving those assets. The other is the so-called estate tax, death tax, some people call it. This is a tax on passing assets at death. It used to apply to a whole bunch more people. When I started doing this over 20 years ago, the federal estate tax exemption amount, the amount after which you have to start worrying about this tax, was only $1.5 million. And you can get up to that pretty quick, even back then, with the value of your property, your retirement assets, your insurance proceeds, that kind of thing. Now the exemption has grown all the way up to $15 million. Up until this law was passed last summer, that exemption was set to sunset. And the law over the last number of years has gone back and forth on this. There have been increases, but a threat that it's going to drop back down. And that has controlled a lot of the tax planning that you may have had with some of your advisors. Should we use this exemption now before we lose it, before it drops down? Well, one of the biggest changes in the OBBBA was to set that exemption at 15 million and make it permanent. It's no longer set to drop at some predetermined time. Congress can obviously change its mind at any time, but that gives us a sense of permanence that we didn't have. So a lot of the planning that we were teeing up early last year, should I make gifts into trust for kids to lock in my exemption amount? We've put the pause on because the threat that you're going to lose that exemption amount kind of falls off the table. $15 million is still, a pretty large amount. And that's 30 million if it's a husband and wife using them both together and able to pass that much down to their kids. So most people don't have to worry about this federal estate tax, but there are some that do. And for those that do, there's advanced planning that you can do to try to get ahead of it. When we talk about the estate tax, we also talk about the gift tax. Those are elements of the same thing. So the gift tax was created after the estate tax was created. People thought, well, I can avoid the estate tax by just giving it away during lifetime, right? So they enacted the gift tax to backstop against the estate tax, to say, if you're going to do that, that's going to count towards the amount that you could otherwise have passed without having to worry about this tax. So when people talk about the gift tax, that's what it is. It's an adjunct to the estate tax. And this $15 million exemption you can use during life, or you can use during death, or some combination of the two. There are certain amounts of gifts that you can give without having to worry about the estate tax. They allow you currently $19,000 per person that you can just give here and there without having to worry about it. But if you give more than that amount, then you have to file a gift tax return and you use a little bit of that $15 million exemption. And there are other things. I pay for my kids' college tuition directly. That doesn't count as a gift because there's a special exception in the law. So if you're worried about the estate tax, then part of the planning is to start using those gift amounts to kind of get some assets out there, out of your taxable estate, without cutting into your $15 million exemption. That's at the federal level. Most people don't have to worry about that. At the state level, there are some people in some states who have a separate estate tax that they have to worry about. Most states have gotten rid of this. So in most states, you don't have to worry about that. But here in Massachusetts, we have one of the more onerous state estate taxes. There's an exemption of the first $2 million, but after that, you get taxed at a rate of 0 to 16% on your estates. And other states have versions of this. Some states have what's called an inheritance tax, which is similar, but it's a tax on the recipients rather than a tax at the estate level. But it's important to be cognizant of the fact that we're not just worried about the federal estate tax. There may be state level taxes that will apply either based on where you're living or based on where your assets are. If you're living in Florida, but you've got property in Massachusetts, this is still going to be relevant for you and part of the planning. If you're looking to sort of get ahead of the estate tax to try to find ways to minimize what that tax burden is going to be. Then there are various strategies that we use for that. Most of those are some flavor of giving assets away now. And you might think, well, if that $15 million exemption applies during life or at death, what's the difference? If I use $1 million now, I got $1 million less at death, so isn't it a bit of a wash? But the key benefit is that if I give it now, I'm hoping I'm going to live a long time before I pass away. And the appreciation on that is outside of my estate. So if I give $1 million now, I only use $1 million of my exemption. But if I'd held on to that million, the hope is it would be 2 million or 3 million by the time I die. So part of the planning that we do from a tax perspective is trying to get some of those assets into trusts and other kinds of vehicles so that the appreciation is outside of that taxable estate. And there are various flavors of that, of different levels of sort of aggressive planning. Here's a list of a bunch of those that we're not going to get into today. But most of these work on the same principle. I'm putting something in a trust, and the appreciation is going to benefit my heirs. And in some of these, maybe I'm getting something back, like a loan to a trust, and I'll get interest back at a small rate, but the growth in excess of that interest benefits my estate. Those are so-called freezing transactions. These are all ways to try to minimize what the eventual estate tax burden is going to be, but without bending out of shape the more important things, which is, again, who do I want to benefit? What kind of structures am I going to set up for them? At the federal level, there tends to be a wider array of things that we do, but there's also relevant planning to be done for people at the state level who may not be worried about that $15 million exemption. That's way more than they're ever going to have. So forget about the federal estate tax exemption. But even at the state level, if you're here in Massachusetts, there are some simple things that you can do to reduce what that tax impact ultimately would have been. And here's just a simple example of that. Imagine you've got net worth of 5 million, you've got $1 million in your home, $2 million in retirement assets, $1.5 million in life insurance. You've got a joint account of 400,000, though I'm assuming here we're talking about the death of the second to die if you've got a husband and wife. Other property of about $100,000. So about $5 million altogether. Federally, we're not worried about the estate taxes. Forget about it. But for Massachusetts purposes, you're going to get hit with an estate tax. And I'll show you what that amount is in a bit. And imagine that we've done the first job, which is what's our plan? What do you want to happen? And the plan in this case is very simple. I want to send $250,000 to my favorite charity, and I want the rest to go to my kids, either outright or in trust, depending on what their life circumstances may be. So if you do no planning, meaning you just say all these assets dump into my estate, I'm going to write a check from my estate for $250,000, and the rest goes out to my kids. You're going to get hit with no federal estate tax, but Massachusetts estate tax of about $264,000. And then your retirement assets, when they dump into your estate, those are all taxable income now in your estate. So that's another $800,000 in taxes. But there are a couple of simple things that we can do to get ahead of that. Looking back at this slide, I'm looking at these assets thinking, this is part of the exercise when we're doing estate planning. Some of these assets I can't really move away. I mean, your primary residence is your primary residence. You're not going to put that in a trust for your kids. The retirement assets, not a whole lot you can do with to get rid of them, now without triggering income tax. But that insurance policy is interesting. $1.5 million is attributable to a policy that's only going to be realized when I die. It doesn't affect my current life cash flow. I wouldn't want to give away the joint account because I need that to live. But the insurance policy, that's something I can work with. And some of the simplest planning that we do at a state level to reduce Massachusetts estate taxes is moving those insurance policies into irrevocable insurance trusts. And it sort of works the same way. You pay the premiums on the policy, but the trust owns it and the trust gets the benefit of it. That moves it outside of your taxable estate so that 5 million becomes, 3.5 million or something like that. And that ends out saving us, about $150,000 in Massachusetts estate tax just by doing that one thing. And then the other sort of simple thing to do is, that you want to give $250,000 to charity. Pick your tax heaviest assets to do that. Well, your retirement assets are likely your tax heaviest assets on death. So send the $250,000 directly to charity. That avoids the income tax that otherwise would have been hit by your heirs on those assets. And then instead of having the retirement assets, which you wouldn't really do anyway, dump into the estate, have it set up in shares for your children so that they can at least defer taking it out over a period of time. And that delays the taxes. It doesn't avoid them entirely, but it spreads it out so we can keep investing in a tax-free way. That's some simple planning that we can do, but that doesn't bend out of shape what we want to do, but is cognizant of the tax consequences of doing A versus B. One thing to keep in mind, though, there's one element to the taxes that we haven't talked about, which is has to do with capital gains tax. We've been talking about making gifts, and in Massachusetts, it's worth noting we don't have a gift tax here, just an estate tax. So you can make gifts right before you pass away and avoid the Massachusetts estate tax. But it may not be beneficial to do that because one of the other things that happens when you die is all the assets in your own name or that are included in your taxable estate get a step up in cost basis. Cost basis is what I paid for it originally, and the hope is that it's appreciated by the time I die. If I sell it, I pay capital gains tax on that incremental difference. When I die, I get a step up to fair market value on cost basis, so you avoid those capital gains taxes. If I give away assets trying to avoid a 16% Massachusetts estate tax, and now my kids have it, and they've got assets where they're going to have to pay a 20% capital gains tax potentially, I've done more harm than good. So it's important to be cognizant of that. If you've got higher basis assets, those may be appropriate for giving. If you don't, and maybe you're better off just holding on to everything and not giving those to your kids. So to summarize a lot of this and get us back into some of the practical blocking and tackling, um, this is a list of 10 tips that one of my colleagues here at Hemingway and Barnes put together years ago. And I find it very helpful on a practical level to reorient everybody on how to think about approaching their estate planning. The first tip is to know what you own. Be aware of where your assets are. This gets back to my first slide. Be aware of how your assets are going to pass in different kinds of ways under the law. Know what the tax basis is for the reasons I just mentioned, the cost basis. If you are giving assets away, be cognizant of try to use higher basis assets and hold the lower basis assets so they can get that step up when you pass away. Know what your financial needs are. Again, on the theory of the tax discussion is the tail of the dog, and you never want the tail to wag the dog. What's more important is that you have what you need to live. So I sometimes hear people talking about, especially back when we were worried about the federal exemption dropping dramatically, should I put all this stuff in what's called a SLAT, a spousal lifetime access trust? And my answer is always never put anything in an irrevocable trust unless you're entirely confident you have everything you're going to need for your life, because that's the most important thing, living your life. The taxes we can sort out later. That's a secondary consideration. We want to be smart about it, but we don't want the tail to wag the dog. Number three, title your accounts properly. Be cognizant of whether you've titled something in your personal name. Well, it's going to pass through probate and through your will. That's great. Sometimes people will set up a so-called revocable trust, not an irrevocable trust, but one that you still control, and title assets in that. That doesn't do anything from a tax perspective, but it simplifies your probate proceedings. So be cognizant of that. Make the right beneficiary designations. Again, back to the original slide, you can do everything right in your will, but if you forget that you also need to deal with your retirement asset beneficiary designations, it could upend the planning that you spent so much time trying to do. Number five, plan for payment of estate taxes, debts, administration expenses, especially if you've got illiquid assets, either hedge fund type interests that you're invested in or the family business. You don't want to have to sell that stuff at a fire sale, or it may not be possible to sell it quickly to pay estate taxes, to pay whatever's got to be paid on death. You want to have a plan for that. That plan could be insurance. That plan could be some other form of liquidity, but that's got to be part of the planning. Number six, and this is one of the most important ones, don't procrastinate. There's a tendency to pick at a plan and sort of get it kind of right, but you're not sure about this, you're not sure about that. And then you go on and on and on. And then I have seen people pass away before they got it just right. And it turned out that they either had no plan, and that's really a mess, or the plan that they had was old and very much not what they wanted. The fact that you've gotten 99% of the way there but never signed it doesn't mean anything from a legal perspective. Until you signed it effectively, it's not your estate plan. So if you're pretty close, sign the thing. And get it in place, and then you can always update it the next month or the next year or whatever it is, but get something in place. Spend time up front to make sure your advisors have a full picture of your assets, your family, your goals. Again, this gets to that original point. When you come to us for estate planning, you're not coming to solve a tax problem, you're coming to solve a life problem. And we can help solve that life problem better if we understand the full picture. And then we can come up with ideas that maybe you might not have thought of. Be realistic about the family's ability to get along. This could affect how you set things up. This comes up a lot when people want to leave vacation properties in a structure for their kids to use when they're gone. That may work, that may not work. It depends on who your kids are, how likely they are to be, to be able to handle that kind of collaboration. Or if you're setting up trusts for your kids, whether you set up one trust or multiple trusts could depend on some of those same variables. Hire good advisors and listen to them. One of the most important pieces of advice I give people when they call me or one of my colleagues about estate planning advice is don't just call me. Call 3 or 4 different people, because you want your estate planner to be somebody that you're comfortable calling, that you feel you're comfortable telling very personal things to. And you can have a very great technical estate planner, but it's just not somebody you think of as your advisor. That's probably not the right fit for you. Keep looking until you find that right fit. You'll kind of know it when you see it. And then when they give you advice, pay attention to that advice, because it could save you a lot of trouble down the road. And finally, keep your plan updated. We like to say that you should take a fresh look at your estate plan at least every 5 years, or if there's a major family event, you've had a kid, you've gotten married, you've gotten divorced, whatever it is. All right, so let's move on from estate planning to the philanthropic side of your planning. We've taken care of our family. We know that they're where we want them to be. Now we're thinking about philanthropic legacy. That may not be part of your planning, and that's perfectly fine, but it often is part of the planning. And that starts during lifetime, and then it also impacts your estate planning documents at death. So let's look at lifetime giving, and that requires us to start with a bit of an overview of how the tax rules work. Again, with a caveat that what's more important is the legacy you want to have. I've had people give multi-million-dollar gifts to charity where they're going to get no tax deduction because what they care about is the impact and less the taxes. But we want to be smart about it. If there is a tax benefit to how we give and what we choose to give, we want to be aware of that and take advantage of that. So from a charitable giving perspective, for the most part, the income tax charitable deduction that you can offset your taxable income with is generally for those who are itemizing their tax deductions, not those who are taking the standard deduction every year. And until recently, it was exclusively for itemized deductions. A number of years ago during COVID, Congress allowed a temporary non-itemized deduction of a few $100s. And that's been made permanent now in the OBBBA. And I'll talk about that in a second. But for the most part, the tax benefits are for those who are itemizing their deductions. There are limitations on how much you can deduct every year as a function of your overall income. And there are benefits depending on the type of property that you give. If you give cash, the deduction is your cash. If you give appreciated property that's risen in value since you bought it, you might get a double tax benefit, the value of the property, plus avoiding that capital gains tax that you otherwise would have paid. So let's talk about the changes to those tax rules that happened last summer under the OBBBA. For those who do not itemize their tax deductions, that deduction is now up to $1,000 per person. That's on top of the standard deduction, so that there is now some benefit to those people, tax benefit in giving to charity. The rest of the changes have to do with those who itemize. One of those changes had to do with how much you can deduct every year. And this slide illustrates that as a function of your adjusted gross income. So except in very rare circumstances, Congress doesn't allow you to deduct 100% of your income in any year, no matter how much you give to charity. There's a limit based on your adjusted gross income. The most favorable limit is for gifts of cash to public charities. For those, you can deduct up to 60% of your adjusted gross income. If you give more than that, that rolls forward for up to 5 years. So you can eventually use it unless you really give more than that, and then it may roll off. But how much that AGI limit affects you depends on to what kind of charity you're giving. Is it a public charity versus a private grant-making foundation? And what kind of assets you're giving. That limit is a little bit lower for gifts, non-cash gifts, gifts of stock and other things. And what you're giving also affects how much of a deduction you can take. In some circumstances, you can take a full fair market value deduction. In some circumstances, you're limited to a cost basis deduction. So you got to be aware of that as you're mapping out who am I giving it to and which assets am I going to pick to make those gifts. Then the other big changes that this new tax law made were to reduce a little bit the benefit of the charitable deduction for those who are itemizing their deductions. And I like to frame this as they took a little off the bottom and a little off the top. And there's no policy reason for this other than they needed to raise some revenue to pay for other things that were happening in that bill. So the little off the bottom is what we refer to as the 0.5% floor. Whenever you're itemizing your deductions, and this is new to the tax law, this did not exist prior to the law last summer, but it's effective now. When you give to charity, the first 0.5 of your adjusted gross income doesn't count. It just falls away. There's certain circumstances where it may roll forward, but for the most part, it falls away. That's 0.5% of your adjusted gross income, not 0.5% of the amount you give to charity. So for example, if your adjusted gross income is $1 million and you give 20,000 to charity, 0.5% floor is of your adjusted gross income. So that's $5,000. And that means that really 25% of what you gave to charity that year doesn't count. So just remember that 0.5 of your AGI, not of the amount that you give to charity. That's the a little off the bottom that they took. Now the little off the top, this is a replacement for what used to be called the PEAS limitations a number of years ago. Before the 2017 Tax Act, there were some limitations on your tax deductions that Congress sort of chopped off the top. This does something similar, but in a bit of a different mechanism. You take all your itemized deductions, you deal with your 0.5% floor, and then you chop off 2/37ths of your itemized deduction, or a formula that's sort of close to that. 2/37 sounds like a pretty random number, and it sort of is, but the concept is that they wanted to effectively freeze the benefit of the charitable deduction at the 35% tax bracket. The 37% is currently the highest tax bracket. For those who are in the 37% tax bracket, you're going to get your deduction chopped down a little bit off the top. If you're not in that 37% tax bracket, that starts at about 640,000. Then you don't have to worry about this bit off the top. The bit off the bottom will still apply to you, but not the bit off the top. But if you are in that tax bracket, it's going to reduce your charitable deduction at least a little bit. And this gets a little aside of what we want to talk about today. But if you're connected with any trusts, or if your estate leaves property to charity, this little off the top applies to those too. And it applies pretty much immediately, just because that 37% tax bracket kicks in right away for trusts and for estates. So this is, I'm not going to go through this in detail, but this is just an illustration of how that little off the bottom, the 0.5% floor, and the little off the top, the 2/37 haircut, apply in practice. And basically, you deal with a 0.5% floor first. You figure out all your other itemized deductions, which could be SALT deductions and various other state and local tax deductions, various other things, mortgage interest. And then when all that's done, you get a number in this calculation, 105,000, and then you do the haircut, apply the haircut to that. So in this case, you've got an AGI of 100,000, you're giving 100,000 to charity. You end up losing about $5,000, a little more of your deduction. It's not a massive loss, but it's meaningful. And the more meaningful, the higher your adjusted gross income is. So that's one consideration, is how much deduction am I going to get? It's going to be a little less impact, although I'm going to talk about a sort of a way around that dependent by choosing certain assets to give to charity in a minute. But the other key question is, all right, now I know how much I want to give to charity. I know how much I'm going to be able to deduct. Which assets should I give to charity? You can give cash. That's very simple and easy, and you get a deduction based on the value of the cash. But one of the things that we try to do in mapping out charitable planning is identify our tax heaviest assets. We talked about this earlier with retirement planning, and focus those on the charitable part of our planning, because those are assets that otherwise I or my heirs are going to get hit with taxes on. I'd rather the charity get hit with those taxes and not have to pay them because they're tax exempt. The two biggest categories of this are one, appreciated property that's grown in value since I bought it, because you can get that double tax benefit of the full fair market value deduction plus the avoiding that capital gains if you do it the right way. The other is retirement assets, which again, otherwise when I take them out are going to get hit at ordinary income tax rates, and I can avoid that to the extent I direct them to charity. For appreciated assets, this is just a simple example of showing how avoiding that capital gains tax, instead of selling it and giving the cash, I may be better off giving the property and letting the charity sell it and have to pay that capital gains tax. With respect to retirement assets during lifetime, the mechanism for tapping into that is what we call qualified charitable distributions. This is a feature in the law that was temporary for many years, but Congress made it permanent a number of years ago as part of the Secure Act. That allows me to, if I'm age 70 and a half or older, to take some money out of my IRA, send it directly to charity, so it never hits my taxable income. And you can do this currently up to $111,000 per year, and that goes up a little bit every year. And if I do that, if I send that directly to charity, there are a few benefits to that. One, it never hits my adjusted gross income. So it's the equivalent of a 100% tax deduction. So it avoids that adjusted gross income limit if that otherwise would have applied to you. But also, we've talked about Congress taking a little off the bottom and a little off the top of your tax deduction. That doesn't apply to qualified charitable distribution. So if I've got cash over here and I'm 70 and a half or older, and I've got an IRA over here, it might be more tax efficient for me to use that IRA and make that gift rather than using the cash that's sitting over here. Now there are more complex charitable structures that sometimes people use, and often these are because you are giving something significant to charity, but you need to retain some sort of income, lifestyle interest. Sometimes there are tax components to that. These are so-called partial interest or split interest gifts. The simplest form are charitable gift annuities. You can do this on lifetime, you can do this at death, where you give an asset to charity, and in exchange, charity will pay you or a loved one an annuity for the rest of your life or for a period of years. There is a charitable giving component to that. This is the charitable part of charitable gift annuity. So the actuarial value of the annuity is less than what you're putting in there by a certain factor, and there's a way that's calculated. So you get an immediate income tax deduction for that incremental value, and then you get that annuity right for forever. And this is something that's sort of quick and easy to do. It's a one-page agreement, and you can put in appreciated property to pay for that, and it can be a way to help avoid the capital gains tax there as well. To a certain extent, it's allocated a bit between the different portions. Another strategy, which is a little more complex, but also more flexible, and you can get a little more bang for your buck. And we're not going into too much detail here, just in the interest of time. But these are so-called charitable remainder trusts. It works on a very similar principle, which is I'm giving something to charity and I want to get a lifetime income stream back. And then at death, it all goes to the charity. With a charitable gift annuity, there's no separate trust. You're just giving it to the charity, and then they have a separate obligation to give you that annuity for your lifetime. With a charitable remainder trust, the very assets that you're contributing support the annuity that you're getting. It goes into a separate legal entity, a trust. And every year, and when you put it in there, this is often used for people with significant appreciated property. They want to put in there, and then it sells in the charitable remainder trust. That avoids capital gains tax because a charitable remainder trust is exempt from tax. And then as the payments come out to you, that taxable income sort of flows out with those payments. So you don't avoid it entirely, but you spread it out, over the lifetime of the payments, which is either for your life or for a period of years up to 20 years. And that can be really palatable for people who have a large asset that's illiquid that needs to sell, but that you can't afford to sort of give the whole thing away to charity. You need to get something back in exchange from it. We see a lot of those in that fact circumstances, but it's useful in other contexts as well. And then the sort of conceptual flip of that, those all involve putting something and getting a lifetime stream and then the rest to charity at the end. The flip of that is the charitable lead trust, which sort of does the opposite. I'm putting something in a trust and payments go out to charity, an annuity every single year. And then after a period of time, the rest goes to my family. That's generally not done for income tax deduction purposes, but it can be a super valuable tool for estate tax purposes. So for people who are worried about the estate tax, we see a lot of these to reduce the eventual impact of estate taxes on your family. And there are trade-offs for that. Your family doesn't get the property for that period of time, but for the right situations and the right assets, it makes a lot of sense. These bargain sales and split interest vehicles are heavily dependent on interest rates. And so one thing I always like to point out is that you want to keep an eye on interest rates. A number of years ago, interest rates dropped down to 1% or even below 1%. And that made some of these strategies super viable from a tax perspective, and it made other of these completely unviable from a tax perspective. Then interest rates rose up to about 5%, 5.4% recently. And that completely flipped which of these strategies make sense and which don't. Now they're starting to kind of taper down again. And as they go down, you may see people shifting from one to the other, just generally speaking. Charitable, certain kinds of strategies as interest rates get lower are going to make more sense. Charitable lead trusts, which I mentioned are big estate planning kind of vehicles, those don't work very well in high interest rate environments. And I know a lot of people who set up charitable lead trusts as part of their estate planning back when interest rates were low. And when we take a fresh look at the math, it doesn't work anymore. So that's something you got to pay attention to. But as interest rates go down again, that'll make a lot more sense from a tax perspective. But then certain kinds of charitable remainder trusts work better when interest rates are high than lower. And we can talk about all this in more detail, or you can with your tax advisors. But just be aware that the interest rates matter and affect what kind of vehicles you're going to use. And then another thing that we often do when we are looking at different kinds of philanthropic strategies, trying to pick which kind of assets does it make sense to give to charity. Partly that's tax driven. So if I've got appreciated assets, that's a really good candidate to give to charity. If I've got retirement assets where otherwise I or my heirs are going to have to pay income tax as it comes out, that's a really good asset to identify for the charitable component of my lifetime and estate giving. But there are other components to that too. One of the key ones, as I mentioned in those 10 tips, is make sure that you've got what you need. You never want to give something away either to a trust for your family or to charity that is something that you think you're going to need for your personal lifestyle, unless you've mapped out something like a charitable gift annuity or charitable remainder trust and you're comfortable with that income stream that's going to be coming back. But sometimes, it's a matter of finding assets that you have that have value, but may not affect your current cash flow and your current lifestyle. A share of your estate's the most obvious example. That's not going to affect your current lifestyle because that's only passing to charity on death. But many of these vehicles are what we mean when we talk about plan giving strategies, things that aren't going to affect your lifestyle now, but can have impact for charity down the road, and allow you to sort of have some sort of impact and legacy, while still being able to do what you need to do while you're here. Life insurance is one example of that. That's not something that affects your cash flow now, except to the extent of the payments that you're making on it. Retirement accounts, especially if you're younger than the age at which you can start drawing from them, those are assets that you can't really do much with yet, but you can plan around them as to benefiting charity and fulfilling those philanthropic legacies. Real estate, depending on what it is, your primary residence is usually not much you can do with, but vacation properties and other things, you may be able to sell, but you may decide you want to put some of those things in some of these vehicles that we're talking about, either family estate planning vehicles or philanthropic vehicles. And closely held business stock. I've worked on situations where people have businesses that may sell, and they give some of that stock to to charity in advance of that. And that may affect their net worth, but it may or may not, depending on the circumstances, significantly affect their daily cash flow. And so they may be more comfortable giving away assets like that, or tangible personal property, collectibles and things like that. Again, things that aren't affecting your cash flow, but they're meaningful, they're valuable. They can be part of that sort of legacy. And then one other thing I like to consider when mapping everything out in the looking at all my assets, again, back to that first chart, is don't just consider the assets that you have that you own personally. Consider other philanthropic vehicles that you're a part of and think about succession planning for that too. So that could be donor advised funds that you may have with commercial donor advised funds or community foundations that run these kinds of funds. What's going to happen if you're an advisor on that fund when you pass away? Can you name your kids to be advisors, or do you want it to close down, but do you want to have some voice in where it goes when it closes down? That's part of the planning too, and we often tend to forget about that because it's sort of over here on the side, but it's still important to you, those funds. And similarly, if you have a family private foundation or one that you set up yourself, think about succession for that. It may be that it dumps into a community foundation fund. It may be that you've got the people who can run the foundation in the next generation, but that takes planning in advance, just like your estate planning takes planning in advance. In terms of retirement assets, as I mentioned before, when we are looking at our estate documents now, when we're passing away, we want to find our tax heaviest assets and funnel those toward the charitable components of our planning. And usually at this point, during lifetime, the tax heavy assets are two things: appreciated property and retirement assets. But the appreciated property part's not a problem anymore, because when you pass away, you get that step up in cost basis. So now it's really those retirement assets that are your primary tax heavy assets, the ones that are going to cause negative tax implications to you. So think about ways to focus those on your charitable planning. These retirement assets are subject to the estate tax. They're also subject to income tax when they pay out, other than Roth IRAs. So if you give these to charity, one, you get 100% estate tax deduction for the value of that. And two, you avoid the income tax because the charity doesn't have to pay income tax when it comes out to the charity. You have to set this up the right way. There are people who, and the best way to do it is to name the charity directly in your IRA beneficiary designation form. There are people who run these through trusts, and there are various reasons why you might do that because of formulas and things that you've got to adjust for. But that is fraught with peril for a couple of different reasons. One, because it's really easy to do it the wrong way and end up triggering income tax at the estate level right away if you don't do it the right way. And there are cases about this. The other is that when people used to run it through trusts, sometimes they would say, all right, we'll run it through the trust, but it's all going to charity anyway, so we'll get a full tax deduction, income tax deduction for that. That used to be the case, but now after the new tax law last summer, that little bit off the top that we talked about, that applies to estates too, even if everything's going to charity. So you end up paying some amount of tax when you otherwise didn't have to. So it's just important to be aware of this. And the final little tip I'm going to mention, this is a little more specific to certain use cases, but I mentioned early on, one of the best planning that we used to do with retirement assets for kids was to set up separate accounts for the kids and allow it to sort of stay in the retirement account for the kid's lifetime. You have to pay out a certain amount every year based often on the kid's life expectancy, depending on various variables. But that way you defer that tax and it stays invested in a before tax basis. Under the Secure Act, that all has to come out now within 10 years in most circumstances and 5 in certain circumstances. So all that amount's going to get taxed earlier. One way you can avoid that and sort of replicate what you used to be able to do is to combine that retirement planning with charitable remainder trusts. So if the retirement account dumps into a charitable remainder trust, now it can pay out to your child every year an annuity amount. When it dumps into the charitable remainder trust, the charitable remainder trust doesn't pay any tax on that. So there's no tax yet. And then as the amounts come out to the child, it gets taxed just as it would have when it came out as a required minimum distribution under the old scheme. But this can allow you to sort of get something roughly equivalent to that deferred payout over lifetime. Now, there are trade-offs to that. When you just name an account for your child, it's your child's. And if your child passes away, it's their asset and it goes to other family members. When you set it up as a charitable remainder trust, when the child passes away, the rest goes to charity. So it works for people who want to benefit both charity and their child and want to find a tax efficient way to do that. It doesn't work if you just want to benefit your child, then you should just do that. You're going to pay the taxes and move on with your life. But for the right use case, I've seen a few people set these up, and it can make a lot of sense. All right, key takeaways, and then let's move on to questions. Again, identify your tax-heavy assets. If you've got during lifetime, your retirement assets are powerful things to use to avoid what would otherwise be an income tax burden on those. Appreciated property, that's low-hanging fruit. If you're picking assets to give to charity, find your lowest basis assets and give those so that the capital gains tax is avoided on that, in addition to getting the tax deduction. And when you're leaving your assets on death, identify the charitable components and try to direct the retirement assets as much as you can to the extent that they would otherwise be taxable to those charities, either directly or through things like charitable remainder trusts. And then think about giving assets that don't affect your cash flow needs. Make sure not to forget that the most important component here is to take care of yourself and take care of your family. Think about what philanthropic impact you want to have. The taxes are all secondary. We'll make that work behind the scenes. But the most important thing is never give away more than you're comfortable giving away. Make sure you've got the cash flow that you need. It's easy to lose sight of that when you focus on the taxes. And finally, I didn't mention this earlier, but when you're setting up bequests for charities, it's really important to coordinate with those charities in advance to make sure that any restrictions or purposes that you want to apply to your gift are something that the university can or other charity can accommodate. I spend a lot of time working with charities on addressing that situation. Somebody's left something that has a problematic restriction that we just can't abide by because it's inconsistent with the law or it's not something we do anymore. And then you end up having to go to court. It's a waste of time and money, and it's uncomfortable. So make this part, even if you're not doing any charitable planning until you pass away, make this part of the current conversation, your plan giving conversations, so that you can work in partnership and both you and that charity can feel comfortable that you're going to have the impact you intended to have and not the impact that some court decided you should have because what you thought was going to work didn't work. All right, let's stop there and see if we have any questions.
Thank you, Brad. This was awesome as always. So much excellent information. Before we dive into the questions, there are a handful of them. For those of you who have questions, and if we don't get to them, we will take note and follow up. If anybody has any specific questions, feel free to email Catherine Bomback. Her email is on the invitation that was sent out, and one of us from our team will get back to you. Also, keep in mind that Brad is providing general information, not individual advice, so always check with your own individual advisors. But let's start with the first. I'm about to sell my company. Should I give shares to charity before the sale?
So that's a really good question and one that comes up a lot. The easy answer is yes. The harder answer is it depends. So yeah, I talked a lot in the last hour about the benefits of giving appreciated property. If you're about to sell your company, the current value is going to be a heck of a lot higher than your cost basis in those company shares. And so yeah, if you wait till the company sells and then you give the cash, you're paying capital gains tax on all of that and then taking a cash deduction, and that's still great. But better if you can give a certain amount of stock equal to whatever it is you wanted to give to charity and both get that fair market value deduction and avoid the capital gains tax. So it's a great strategy to do. The tricky thing is to be aware of the timing. So there's this concept in the law called the assignment of income doctrine, which basically says, or at least the version of it that's relevant to this, says that if by the time I give that stock to charity, the sale is kind of locked in, it's a practical certainty, to cite the cases on this, that the sale is going to happen. Like it's all signed up, the shareholders have voted for it, but the closing is next week. And now I'm giving it to charity. At that point, the law says sorry, it's already been sold. You're going to hit that capital gains tax. It's going to be treated as if you took in that tax and then made a cash contribution to charity. And there are a whole bunch of cases out there where people thought what they did worked, but it was just too far down the road. So be aware of where you are in that process. If you've signed an agreement to sell and there's just some contingencies left over, chances are it's not too late to give the sale proceeds if that's what you want to give to charity, but it's probably too late to get the stock and get the tax benefit you're going to give. And it's a complicated facts and circumstances analysis, so you need to talk with a tax advisor on the specific facts at hand. But that's sort of a rule of thumb, is if you're either close to or have signed like a purchase and sale agreement or something similar, you're probably too late. Before that, there's a conversation to be had. And if you can do it, again, it can have a really, really great beneficial tax impact.
Great, thank you. Which assets are better to live off now, tax deferred or individual brokerage? This is a three-part question, so that's the first.
Yeah,
The
sure.
second
All right.
is,
Oh, sorry.
oh, go ahead.
No. Yeah. So just on the first one, we tend to assume in planning that deferral of tax is a good thing. And the reason for that is that you're investing on a pre-tax basis. So you've got a larger denominator that's investing, so it's going to grow more before the tax comes out. So the general default rule is better to live off of the assets that are after tax than the assets that are before tax. So keep the tax deferred for later things, save them for your charity, your philanthropic gifts, or at least defer when that tax impact's going to hit.
Okay. What's best to lessen the impact of taxes for my heirs? And can charitable giving help with that planning? Which you,
Yeah, I mean, sure. Yeah, no, absolutely. At a certain point, you're going to pay some taxes, right? I mean, there's income tax, there's estate tax that may or may not apply. There are very few strategies, and I would say no strategies with one or two technical exceptions, where if you're not interested in giving to charity, involving charitable gifts is going to make you better off than if you just paid the taxes and moved on with your life. On the other hand, if you are interested in giving to charity, if that's a component of your planning along with benefiting your family, then there are absolutely better and worse from a tax efficiency perspective strategies to use, and ways that you can save a heck of a lot of money by doing the charitable planning in a certain way and using certain kind of assets to focus on that.
regarding retirement accounts, IRA and designated beneficiaries, what are the pros and cons of designating adult individuals versus a revocable trust that will in turn name adult individuals as beneficiaries? I'm particularly thinking about avoiding probate.
Yeah. No, that's a great question. It used to be before the Secure Act that a lot of our estate planning around retirement assets involved naming revocable trusts, which become irrevocable on death, separate share trusts for your kids, so that the retirement assets go to the trustees. The trustees control the flow of funds. If you just name your kids directly, they could pull it out on day two. They're not limited to that required minimum distribution. If you don't trust that, or you're worried about creditor issues, then you would often send it to a trust instead. So that, and the trusts have to be set up a certain way so that you get that same tax deferral you would get for an individual. But after the Secure Act made it impossible to stretch out an IRA for a child's lifetime, a lot of that planning fell by the wayside. There are still ways to do that. There are certain kinds of trusts called accumulation trusts that you can set up with your retirement assets and still get the 10 years that you would get for an individual. But then there's still some flow through that has to happen with the assets passing on. So you can't protect all the assets from the child getting it, but there can be benefits to setting it up in a way that allows a trustee rather than your child to decide when to turn the tap in excess of the minimum payments that have to kind of flow through.
All right, I've got two more. One, will the slides be available after this presentation to share with everybody?
Far as I'm concerned, yes.
Perfect. Then yes, we
Yeah.
will we will
Yeah.
get those out.
Yeah.
And then finally, should I leave a vacation property in a trust for my kids to share?
Oh, what a question. I hinted at this a little bit earlier that, that's one of those 10 tips that I mentioned was be realistic about how well your kids can get along. People do this. I mean, you've got a vacation property, the kids love it, the grandkids are starting to come there. You want it to continue to be that focal point for the family, but you're not going to be there to control its use, and you're not going to be there to pay the expenses and all of that. So you say, all right, I'm going to set up a trust, or I'm going to set up a limited liability company and put the property in there. And there's going to be complex mechanisms about how the kids decide who gets to use it which week and how the expenses are paid. I've seen that work less frequently than I've seen it fall apart. Because it may be that your kids get along great and that they're likely to get along great when you're gone too. And if so, that's wonderful. Often that's not the case. Either they don't get along now, or there are already cracks in the seams, and when you're no longer there as the family glue, it's going to fall apart. And then people get upset because child one lives nearby and uses it all the time. Child two lives in California and thinks, why am I subsidizing this thing? And I've moved on to other things. So this is not to say don't do it. It can make a lot of sense, but the best advice I have is, one, you need to endow it. You need to plan for how the expenses are going to be paid so that the kids don't feel like now they've got this cost in addition to the ability to use the property. And if you can't endow it, be realistic about whether it makes sense to sort of keep it as an aggregate family asset. Two, if your kids are adults, have an open conversation about it now. It may be that the kids love it when they're there, but they may say, look, I'm moving to California. I'm really not interested in this. It's great, but I don't want this to be part of what I'm doing. And then you can direct it in your estate plan to the other kids and have compensation, whatever, find some other kind of plan. Or if they're children, they're too young yet to make those kinds of decisions, have a trusted advisor, a trustee who has enough flexibility to make a reasonable judgment and say, this isn't working. I'm going to sell the property and distribute out the cash.
Great. Thank you so much. We are right at time. That was perfect timing, actually. So thank you so much, Brad, for your expertise and willingness to share this with everybody. If anybody has questions, please feel free to reach out to Catherine Bombach or reach out to the gift planning at northeastern.edu email. All of us have access to that. And thank you again for participating. Thanks, everyone.
Thank you
Thank
all
you.
so much.